Hi, welcome. In this session, I'd like to talk about three companies, all of which I think are household names. The first is Intel, until very recently a tech superstar, but it's fallen in hard times. The second is Walgreens. If you've lived in the US or you visited the US, you've noticed a Walgreens pharmacy pretty much around every corner, second largest pharmacy chain in the US. And the third is Starbucks. And no matter where you live in the world, it's a company that's reinvented coffee, much to the dismay of the Italians who truly own that right. What do they share in common? They're all in trouble. How much trouble? We'll look at the differences across the companies, but clearly the market has turned against them. And I want to use this session to talk about what it is that these companies are dealing with, and more generally, how companies deal with decline. This ties very closely to the session I did a few weeks ago on the corporate life cycle when I published my new book on the corporate life cycle, where I talked about how companies age. A startup is like a baby, a young company is like a toddler. You have high growth companies and you have middle-aged companies, mature companies, and then you get old, you decline. And like human beings, I said, declining companies fight aging. I believe that managing and investing in declining companies is often more difficult than investing in growth companies or mature companies. The reason, of course, is very simple. When you manage a declining company, you constantly try to make yourself young again. Why? Because who wants to get old? And companies don't either. And you have bankers and consultants telling you can be young again, often giving you examples of other companies that have reincarnated. So what I'd like to do is use Intel, Starbucks, and Walgreens to talk about decline as a process, what the choices are, and for these three companies at least, what the best choices might be going forward, both for management and for investors. So let's get the show on the road. As I said, the one thing that these three companies have in common is over the last year or so, these companies have all hit hard times with the market. The market has turned against them. In fact, you could argue it's gone longer than that. In this graph, I've looked at the stock prices of all three companies starting in 2019 going through 2024, the last 5 years. And over the last 5 years, you look at the compounded annual return. Starbucks has a compounded annual return of minus 1% a year. This is a period when the market has been up 12-15% a year, minus 1% a year. Intel, minus 18% a year, and Walgreens, minus 30% a year. Clearly, the market has turned against these companies for a variety of reasons, and one of the things might be a slowing of growth and how the companies and investors are dealing with that slowing growth. So let's start with Intel. Tech superstar, a company that was founded in 1968 but really took off in the 80s and the 90s. One of the people who founded, of course, was Gordon Moore, and you've all heard of Moore's Law and how quickly things change and how much the speed of a computer chip adjusts over time. But the CEO who made Intel the company it is today was Andy Grove. Incidentally, Andy joined the company on the day of its incorporation in 1968. He grew with the company, became a CEO, and essentially helped make the company the superstar that it is before he had to step down in 1998. In fact, his theme in management was that companies need to experiment and stay adaptive, one step ahead of the curve. And the title of his book was Only the Paranoid Survive, arguing that no company should ever get comfortable with where it is. Perhaps an appropriate book for Intel to take a look at in 2024. Now, one way to understand how Intel has changed over time is to look at its operating history. And starting in 1994, this graph looks at the last 30 years. It looks at revenue growth and gross margins and operating margins. Revenue growth, of course, captures the growth part of the business model and how that's changed. And you can see over time, revenue growth has decreased. This is not a problem that started 3 years ago. You can see in each decade, Intel's growth declining. It's a classic case study of a company aging, lower growth as it scales up. The second metric I looked at is the gross margin that measures the unit economics. And on this dimension, Intel's unit economics have actually improved slightly over time. Not by much, but the gross margin has gone from 56 to 60% at least through 2021. We'll hold off on the 2022 to 2024 and the bottom fell out. On the operating margin again, pretty healthy margins all the way through 2021. So all that happened in the last decade at Intel was growth dropped off, but the company stayed incredibly profitable. And then you get to 2022 and 2024. Clearly, the bottom is falling out. Revenue growth goes into negative territory. The revenues are shrinking. The unit economics seem to collapse, and the operating margin is approaching zero at a pretty fast rate. Clearly, the company is in trouble. Now we'll look at what might have driven it there, but as the operating metrics for Intel have kind of deteriorated, the market has taken notice. In this table, I've looked at the top 10 semiconductor companies by market cap every year, for every decade, from 1990 all the way through 2020, and then the last, 2022 and 2024. 1990, Intel was the fourth largest semiconductor company in the world. It was starting its rise. By 2000, it had ascended to the top. It was the largest semiconductor company in terms of market cap. It stayed there for 20 years. That's a pretty long run for a tech company. In 2022, it dropped to third, and by 2024, it had dropped off the list. And of course, a superstar emerged. Nvidia had risen to the very top of the list. Now you're saying, what went wrong? Now, it wasn't that Intel, in fact, when you look at that table and the previous graph, you're probably saying, why wasn't management trying something? I think the problem is it was trying to do too much. It was trying to do too much on two dimensions. One was Intel was investing heavily in its chip manufacturing business called the Intel Foundry, trying to match up to TSMC, the biggest chip manufacturer in the world. At the same time, Intel was investing immense amounts on the next new generation of AI, AI chips because it wanted to claim market share back from NVIDIA. So clearly it was trying to get into both segments of the business. And in my view, it tried to do too much because it was, in both the big markets, I'm not denying that, but I think on both these markets, Intel was too late to the game and had given up too many advantages to these companies to go after them in the form that it did. A benign reading, of course, of the Intel investments is that we're not giving Intel enough time and that the Intel Foundry and the AI chips are going to come out and it's all going to be okay again. That's not the assessment the market seems to be making. A not so benign reading is that Intel's throwing money at trying to be me too with these successful companies and that it's going to be money wasted. So let's hold that thought. That's the first of the three companies. The second company is Walgreens. Walgreens is an old company. It's a company that was founded in Chicago in 1901. It's more than 120 years old. It went public in 1927. It's been public almost 97 years. And about 10 years ago, in fact, almost exactly 10 years ago, it acquired Alliance Boots to become a much larger company than it was before and get a global presence. That acquisition, and we'll come back and talk more about it, was a hefty, came with a hefty price tag, $15.3 billion. Let's look at how all this played out in the operating metrics. Again, as with Intel, I broke down revenue growth, gross margins, and operating margins by decade. Very different business already, right? If you compare the gross margins for Walgreens against that of Intel's, much lower gross margins. The unit economics are just not as powerful in this business. It's not the company's fault, it's the nature of the business. Remember, the heart of Walgreens is their pharmacy business, and the cost of the products they sell is a significant portion of their revenues. But if you look through 2021 again, there's a slowing of growth, but the margins are holding up pretty well, though in the last decade you started to see both the gross margin and the operating margin dropped off. And again, you get to the last 3 years, you get a much more significant drop off in the gross and the operating margin. Again, clearly in the last 3 years, something has happened at the company. And the question is it reversible? What is it? And to answer that question, I decided to take a look at CVS. You're saying, why bring CVS into the picture? Remember, I said that Walgreens' biggest business is the pharmaceutical business. It's the pharmacy business. And the largest pharmacy company in the US, of course, is CVS. And I wanted to see how much of the problems we see in Walgreens is business-wide and how much is company-specific. And if you look at what happened to CVS over the last couple of years, you see the drop-off in market cap in CVS. The difference, though, is Walgreens' market cap collapse has been much more dramatic. In fact, for a brief period in 2016, Walgreens had a market cap that exceeded CVS's market cap. Now its market cap is 1/10 of the market cap of CVS. What does that tell me? Well, it tells me that the pharmacy business is in trouble, but Walgreens has brought on other troubles on top of the pharmacy problems because its stock price has performed so much worse. Again, you might say, well, why wasn't management doing something? I think it was, but I think it was doing some of the wrong things. In 2021, Ross Brewer was brought into Walgreens from Sam's Club, and she was given this mission of turning the company back to being a growth engine. And one of the things she decided to do was to go out and do acquisitions to acquire growth. Now, if you've listened to me enough, you know that I'm pretty cynical about growing through acquisitions. The session I do in acquisitions is called Acquirers Anonymous, 7 Steps to Sobriety. It gives you some insight on what I think about acquisitions. It's a value-destroying exercise for the most part. And one of the things that Ms. Brewer bought was Village MD, a chain of doctor practice and clinics. And you can already see why, right? One reason CVS was able to survive the kind of drop-off in pharmacy business was because it had those minute clinics in CVS, and this was Walgreens' attempt again at Me Tooism. That acquisition, though, cost $5.2 billion, and over the 2 years that Village MD has been part of Walgreens, it hasn't worked that well. In fact, in 2024, Village MD scaled back its growth plan, saying, hey, this business is not as lucrative as we thought it was. So again, it's not as if management is not trying. Perhaps they're trying too hard to go back to something that they cannot do. So let's talk about Starbucks, right? I get a Starbucks cappuccino once in a while, and it is quite clear that this company, whether you like it or hate it, has changed the way we drink coffee. In fact, just as an experiment, I went into in Italy, how in Italy they have cafes all over the place where they serve you, espressos. And I went and asked him, asked the gentleman behind the bar whether he would give me a grande caramel macchiato with oat milk. He looked at me like I had two heads, and he said, we have espresso, we have a cappuccino. And I said, what if I want a large cappuccino? He said, then drink 4 cappuccinos. That's the difference Starbucks has made, is we think every coffee shop delivers coffee in cups the size of Alaska. It's huge cups, and in 15,000 different varieties. Early on, Starbucks, of course, the name you associate with the Starbucks story is Howard Schultz, right? You probably might have read his book about, his story. His notion of Starbucks was coffee shops where people could gather together, have coffee, talk to each other. He wanted to bring that cafe experience to the US, and he did by opening more and more stores. There was a point in New York where, around NYU, in a 6-block area, we had 8 different Starbucks. You could just walk from one to another within 3 minutes. They were cannibalizing each other. Schultz, of course, was CEO from the company from 1986 through 2000, but he didn't go away, right? He came back again from 2008 to 17 to rescue the company, and then, he left in 2017. But then again, he came back in 2022 because Kevin Johnson was the CEO, retired, and they had no CEO, and he filled in until Lakshman Narasimhan became CEO in 2023. And of course, to complete the story, after the troubles that Starbucks has had in the market, Mr. Narasimhan had to leave, and we have a new CEO. We'll talk more about whether that's going to change the story. But again, let's start by looking at the operating history. And Starbucks, the history is a little different than the Intel and Walgreens graphs. We saw a big drop-off in operations. In fact, if you look at the Starbucks numbers, you really don't see a dramatic drop-off between 2022 and 2022. It's true revenue growth is a little lower, but not by much, right? 7.87% versus the 9.52% of the previous decade. Gross margins dropped a little. Maybe the unit economics are a little worse. The operating margin, a little drop off again. So you're saying, what's causing this angst? We'll come back and address it, but clearly you're not seeing a dramatic drop off in any of the numbers in the last 3 years. There is, if you shop at Starbucks, so you probably have noticed a pattern. Now, 5 years ago, 10 years ago, to order Starbucks, you had to go into the store. You stood in line. You ordered the coffee. You got the coffee off, and you sat there and drank the coffee. Now, increasingly though, we order our cappuccinos, our lattes, our caramel macchiatos on our phones, and we go in and just pick it up. That online ordering model, and you can blame COVID for this. After all, we blame COVID for pretty much everything under the sun. It's kind of changed the business model at Starbucks. I think last year, almost a third of the revenues came from people ordering online and picking up at the store. And it changed the logistics of a coffee shop. In fact, if I stood in line and ordered a cappuccino at Starbucks, I'm going to be pretty pissed off because you'll have 15 online orders being filled while you're waiting for your order to be delivered. It's changed the nature of Starbucks as a company, and you could argue that perhaps it's changing the storyline, and that might be Starbucks' biggest problem. Starbucks no longer knows what it is as a business, and that might be getting in the way of the market attaching a value to it. In fact, one way this has played out is in a good way. If you look at Starbucks at its pre-2008, when they were opening a store blocks from each other, you weren't getting very much in terms of growth from same store sales. You're getting growth from opening new stores. Over the last 10 years, 15 years, that's changed. Right now, Starbucks gets more sales per store than it ever has. So in some ways, Starbucks is healthier than it used to be. And the angst, I think, then has to be, what is it that's making investors so upset with Starbucks? One is, I think, Starbucks has acquired an investor base that believes it's entitled to growth, that they bought a growth company and the company should be delivering growth, and Starbucks has tried, right? Let's face it, for Starbucks to deliver the kind of growth, it can't be in the US. It's a saturated market. The two big markets where Starbucks can go to get additional sales are China and India. In India, Starbucks has kind of cut off that route by having a joint venture with the Tata Group. So the real market that Starbucks is hoping to use to fill in their growth plans was China. And in China, Starbucks has faced a challenge because Chinese domestic coffee makers like Luckin Coffee underprice Starbucks, and the Chinese consumers are not as willing to pay Starbucks prices. So it's not showing, it's relative. Starbucks is still growing, but maybe not as much as these investors thought they would. That's the first one. The second is, and you all know how much I think about, stories and narratives, how a company is not selling numbers, it's selling a narrative. I think the Starbucks narrative is broken. That for a long time, the narrative of being a coffee shop and growing through people coming into the coffee shop was what drove the company. Right now, I'm not sure what the Starbucks narrative is. What are they trying to do? And I'm not sure Starbucks knows what its narrative is. And that can become an issue in markets, and I think it has become an issue. And finally, I think inflation has had a toll. When you order a venti latte, it costs you $6. You order a venti specialized drink and you add 3 different things, it could be $8. It's a lot of money. And you could argue that there's a cost issue that's getting in the way of growth as well. So all of those things, I think, are undercutting the Starbucks message. So with that lead in, let's talk about what to do when you're in decline. I'm not sure Starbucks is in decline, but let's talk about what it is that makes it so challenging managing a company that is beyond middle age. And I'm using that word to be polite. Old sounds so bad. Now, there's a lot on this page, so let me talk a little bit about what I'm trying to do here. So let's say your company is entering decline. Here are the choices you face. I've classified them into 3 groups. Destructive choices, it depends choice, which could be good or bad depending on how you structure it, and constructive choices. Let's start with the destructive choices. The most common destructive choice made in the face of decline is denial, where you look at the decline you have in revenues and your margins coming under pressure, and you always blame somebody else. Macro factors, extraordinary circumstances, bad luck, it's always somebody else's fault. And what do? You do what you always done. You keep doing, you stay with your existing policies, the investing, financing, and dividend policies, because you're convinced everything's going to become okay. If you do that and you're truly in decline, the outcome is almost predictable, right? The truth eventually catches up with you, but not before you've sunk tens of millions, even billions of dollars into a business that is really uninvestable. That's denial. Second is desperation. Desperation, you realize your basic business is in decline, but you're desperate to go back to growth. So what do you do when you're desperate? You throw stuff at the wall, hope something sticks. You make big bets. This is where acquisitions come in, right? And your bankers will aid and abet this process by saying, you can do it. Enter this business. You make big bets with low odds, hoping for a hit. Now, clearly, the outcome here for owners is almost never good. Okay? You write off those acquisitions. But for managers, there is a silver lining in this approach, because if those bets play off, because even low odds sometimes pay off, these managers become superstars. So you denial, you got desperation. Let's talk about survival. I misspelled survival, but I'll fix that. Survival at any cost. Now, I'm not a great fan of sustainability by itself, where, especially corporate sustain. I understand that you want to sustain the planet. We're all stuck on this planet. We want it to be sustained. But sustaining a company at any cost, that's a terrible objective to have. But if survival at any cost becomes your objective, here's what you do. You realize your core business is in decline, but you keep the company going because you think your job is to keep the company alive. So every financial policy you take will be to ensure your company survives. As an outcome, what's going to happen? You have what I call zombie companies. Companies that are walking dead, companies that survive, but they're in bad businesses and they leak value over time. Those are the destructive choices. There's an it depends choice. Me Tooism. What do you do in Me Tooism? You know that your company is declining, but maybe there are other companies in your peer group that are not. So what you effectively do is, I think human nature, you try to imitate them. You try to do what they do. I think of what Intel did in 2021, right? It tried to be like TSMC and tried to be like NVIDIA because they were successful. You think, what's wrong with that? It could work, right? But in most cases, you're coming to the game late. There are established players who are better at this than you are, and you often end up underperforming. And then you have constructive choices. And let's look at the 3 constructive choices. The first is accepting where you are in the life cycle and behaving accordingly. So you know your business is declining. It's not a great business. So you know what you need to do, right? The sensible thing to do if you're in acceptance is you not just invest less, you start divesting, you start to shrink as a business, you bring down your debt, you return more cash to your investors. You're saying, but that'll make my company smaller. You're okay with that. It's better to be a small company in a bad business than a big company. That's acceptance. Easier said than done, but for many companies, the most healthy choice. You could try for a revamp. Basically, what you do is you take your business, you accept that it's in decline, but then you try to take your product and service and you either redesign it or you go after new markets, not hoping to go back to growth, but at least to go back to some mature phase where you can keep going with reasonable growth. So your company reverts back to an earlier life cycle, but in a slightly different form than the existing one. And then there's the dream for every company in decline. Maybe I can be born again. Reincarnation. Apple in 2000, Microsoft in 2013. You use the cash flows from existing business to enter some new and extraordinarily high growth business. So you seek out a new business we can enter with your strengths, you invest and grow your businesses, and over time you reinvent yourself to become a different company. Now when you look at your company saying, how do I know which one is right for me? Here are the things that are going to play in. First is, are you a declining company in a healthy business? It's easier to devise pathways back if you're in a healthy business, because the market itself is big, the business is healthy. But if you're a declining company in a business where everybody's declining, much more difficult to pull off. Second, do the decision makers in the company have skin in the game? Do they own equity? It's easy to make big, long odd bets with other people's money. If it's your own money, you're going to be a lot more cautious. The third is, when you're in decline, management starts to matter more again. If you're a middle-aged company or a growth company, you can get away with AI running your company. Management quality is most critical early in the life cycle and late in the life cycle. Do you have the right management and does it fit your company? The fourth is, does your company have any strengths? The fact that you're in decline doesn't mean you don't have any strengths. Your pathway back has to be built around those strengths and what those strengths are. Fifth, who are your investors? Are they in a hurry? If they're in a hurry, they're going to push you down the pathways where they get the cash back. A lot of declining companies end up with a private equity investor, often an activist in the ranks, makes it much more difficult to say, I want to revamp or reincarnate if you have those investors. It's easier to devise pathways back to health if you're in a capital market where capital is accessible and it's healthy. And finally, external factors come in. Governments, for instance. What can governments do? Well, remember, after 2008, you're too big to fail. Governments actually came into declining companies, gave them capital, and kept them around. And you could argue that this is a factor that sometimes can make a difference and leave declining companies continuing. And that's not often good for the sector. And finally, luck. Much as we'd like to act like everything is in our control, luck can play a factor in what happens as well. This is the framework I'd like to use to look at the three companies that are part of this exercise. So let's try this out on our three companies. Let's start with Intel. In my view, Intel's problems stem from the fact that they've tried to be not just Me Too, but Me Too in a very big way. On both AI and the chip manufacturing business, Intel was not just going after NVIDIA and TSMC, but trying to supplant them, be as successful as they are. And I don't think they can do that because I think NVIDIA on AI and TSMC have competitive advantages that will make them the leaders. But that doesn't mean that there's no hope left. The business is big enough, the AI market is big enough, and the chip manufacturing business is big enough that Intel can grow, but at a much more modest pace. So it's almost like they need to bring their ambitions down, not try to be leaders. It's tough to do when you're a company like Intel, which has been at the top for so long. And to reflect this, I actually tried valuing the company with modest growth and not that high margin, and see if I could get to the $18.89 per share the stock was trading at. And if you look at the table there, you can see that with a 3% revenue growth and a 25% margin, I get a value per share of 23.70, higher than the price. 3%, of course, is low revenue growth, and a 25% margin is actually lower than the margin Intel used to earn in the last decade. So I'm not asking for much. In fact, you could probably get that combination without succeeding in the AI market or the chip manufacturing market. And even if they can get some success there, not even the kinds of top level success they want, it's icing on the cake. I think the odds are in my favor with Intel, and I did buy Intel at 1889. With Walgreens, though, I think the problems are more intense. With Intel, at least, the rest of the business is healthy, even though NVIDIA might be taking a disproportionate share of it. With Walgreens, the pharmacy business, and you saw this with the graph, is broken. It's being disrupted, and I don't think it's going to come back anytime soon. Does that mean Walgreens is doomed? Not necessarily again. I think they could shut down their least productive stores, shrinking their presence down to a smaller presence. They can survive, but I have to be realistic when I value the company. And I think it's all going to boil down to what the margins will look like in this slimmed down version of the company. In fact, if you look at the values that I got per share, with 2 or 3% operating margins, I end up with values not just below the 877 the stock was trading at, but often in negative territory, which means the company will not make it. I need margins of 4% or higher to get to values above 877. And while there are plausible paths to get there, I'm not willing to make the bet. I think the odds are less with me, or perhaps more against me on this one, so I'm going to steer away from Walgreens. Which brings me to Starbucks, and I'm not sure Starbucks ever belonged in this trio. If you remember, Starbucks was the only one of the three companies that didn't see a collapse of margins in the last 3 years. It did have slightly lower growth, but I do think it's lost its storyline, and I do think that that's going to be the task for the future, is whether they can find a narrative that investors can latch onto. However, to set that narrative, you need a visionary, and as many of you might know, in the case of Starbucks, they have a new CEO in place. a gentleman named Brian Nickel who came to with pretty good, with a pretty good pedigree. He's run Taco Bell and Chipotle, and I think he was hired by the board because he had that logistics experience. But does he have the vision? We're not sure yet because he hasn't given us that vision that he has for Starbucks. And the initial news stories are not exactly promising. And you probably read some of them of him living in Southern California and flying by corporate jet to Seattle to run Starbucks. I don't think you can be a visionary CEO and a part-time CEO at the same time, but maybe I'm being a little unfair here. But as an investor, I look at Starbucks and I'm not that excited to buy it at 91.15. In fact, I tried valuing Starbucks with a combination of growth and margins reflecting different parts of their history. In fact, if I give them the margins and growth they had in the last 3 years, the value per share I get is 55, well below the 91. If I give them the higher growth and the higher margin they had in the last decade, I'm still at 64. If I go to the 16% growth rate they had between 2002 and 2011, but the lower margins, I'm at 48. Like the only way I can get to 91 is if I give them the growth they had between 2002 and 2011, 16%, and the margins they had between 2012 and 21, 15.14%. That's the only way I can get to 91. And I don't think that's going to be easy or even plausible to get to. So even if Mr. Nickel comes out with the storyline that is attractive as a vision, at $91 per share, that vision is already priced in plus more. And I don't see Starbucks as a great investment at 91. So what's the end game here? I think people love to be entrepreneurs. Everybody wants to have a startup and build a business, and I think that's entirely understandable. And I think often when you look at governments, they want to encourage entrepreneurs, they want to allow for these startups, and that's a sign of a healthy economy, to have risk capital, to have an environment where startups can grow and succeed. But just as much in a healthy economy, you need to have a good way of dealing with decline. Now, a good way of dealing with decline is not fighting it, not keeping zombie companies alive. In fact, Joseph Schumpeter is right about capitalism being creative destruction. Now, companies which have lost their reason to exist should fade away. There's no glory in survival for the sake of survival. But the reason I think people fight decline so much, and I think we need to take the blame on in business schools and as writers of business books, is we glorify empire builders. We glorify people who reincarnate companies. Now, Steve Jobs became a legend because he allowed Apple to reincarnate. But I don't begrudge these empire builders their glory, but at the same time, we need to also glorify empire shrinkers, people who come into businesses which are declining and do the right thing, make those businesses smaller, because that's the only way we will get CEOs to do the right thing. And as investors, I know that the big companies, the Mag Sevens, the Fangam stocks, companies that become trillion-dollar companies, are the ones that get all the glory. But perhaps we should reserve some of that glory for companies that are in decline, where the managers come in and do the right thing and deliver these outsized returns for investors. And after all, if I make a 200% return on a declining company that's managed right, it's the same 200% return I make on a growing company that's managed right. So perhaps we need a change in mindset and not fight aging as much as we do and accept it as inevitable in companies and deal with it in a much more healthy way. I hope you found the session useful, and I thank you very much for listening.